With 2023 ending soon, have you benefited from the many tax savings and financially smart strategies that need to be completed before year end? If not, don't worry, this is the video for you. From maximizing your retirement account contributions, to Roth conversions, from gains losses harvesting, to savvy educational funding and estate planning ideas, this video highlights 7 tax savings and financially smart moves to make before year end, which will grow your financial strength and independence. Welcome to Wealth Matters for Physicians, the channel brought to you by Altfest Personal Wealth Management that provides physicians with key investing and personal financial planning strategies. For 40 years, physicians have relied on Altfest to help them achieve their financial independence and the future that they deserve. We can do the same for you. My guest today is Steve Novak. Steve is a CPA, a certified financial planner, and a senior financial advisor at Altfest. Today we're highlighting 7 tax savings and financially smart strategies to take care of before the end of 2023. I will name each strategy, and then Steve, you can give your thoughts on what's important to know for each one. The first strategy is maximizing your contributions to workplace retirement plans and IRA accounts. Steve, what do you want our physician audience to know about this?
When you first think about maximizing your contributions to your 401k plans through your company, the first consideration that you really want to look at is what match they're going to provide you. You do want to make sure that you take advantage of a match. If they match the first 4% of the contribution you have, then you want to do at least 4% of your income. Other considerations are to maximize not necessarily the tax efficiency today, but the tax efficiency over the life of the contribution. So you can look at it and try and figure out if there's a Roth contribution option, whether you should be doing a traditional or a Roth contribution for these contributions that come through each year. From an individual standpoint, if you don't have a coverage plan, an individual IRA is another option to think about to use for yourself, but that also has the same consideration of whether you do a Roth or a traditional IRA.
Right, and you want to try to max out as much as possible, right?
As much as you can afford to do, assuming that you are in a higher tax bracket now and a lower tax bracket later in life, you always do want to take that into consideration and try and take advantage of those situations.
Thank you very much. The second strategy is to determine whether a Roth conversion makes sense for you this year. Steve?
A Roth conversion is taking advantage of years, well, the goal is to take advantage of years where your tax rates are in lower brackets. So what we actually would do is take money that is in traditional IRA or traditional 401k plan that you're allowed to convert, assuming there is an ability to do that in the 401k plan, and move it into a Roth account. You would pay the tax as if it was a distribution today, but then all earnings from that point forward and when the money is taken out, if it is ever taken out, would come out tax-free. So the goal is, as I said, to maximize if you're at for some reason at a lower bracket around 22% this year because there's just a timing difference in your income and you know your income is going to go up to the 35% tax bracket, let's say next year, it's a good year to try and do that and hopefully take advantage of that 13% differential in the rates.
Great. And I mean, yes, definitely this is something that we help our physicians with all the time. Whether a Roth conversion makes sense this year, it may or may not. And to let you know, we have a great video specifically on Roth conversions that we did recently, and I'll put a link to that in the description of today's video. The third strategy for today is to make sure you take maximum advantage of all the itemized deductions that you're entitled to. Steve, what do you want our physicians to know about this strategy?
The typical Schedule A that everyone has become accustomed to changed with the Tax Cut Jobs Act that was passed back in 2017 and took effect in 2018. That added the SALT limitations, increased our standard deductions, and changed how we looked at itemized deductions and how things would go back and forth. Because the standard deduction is so high and your limitation on your state, local, and real estate taxes is limited to $10,000, there are ways to take advantage of that. You want to pay attention to try and group medical expenses, charitable deductions to specific years. So this way they add up and you can go well above the standard deduction. And then in other years, when you don't have those, you use the standard deduction. So there are ways to, look at the system and play with the numbers and make sure if you can allocate a lot to one year and not the other, that you can maximize your benefit and actually receive a higher overall tax deduction.
Great, and these are questions that you can definitely be asking your accountant and also your financial planner to give you put more meat on the bone to help you to be better, have the ammunition to get the most out of this strategy. The fourth strategy for today is identifying opportunities for not just loss harvesting, but also gains harvesting and loss harvesting in a very deep level. Steve?
Traditionally, we would look at someone's individual position on a yearly basis and see if there are tax losses or gains, depending on your tax bracket, to take advantage of a lower cap gains rate, or if you're at a high rate, we would take a loss to try and offset some of the other gains that you have. Most people think of that and look at a position. Let's just give a quick example. You have a Boeing stock, is the example I usually use, where you have an overall gain on a few hundred shares. But it's possible that you bought that over multiple purchases, and why 90% of them are gains, there could be one lot that's at a loss. A client that I'm using as an example actually had one lot where they were able to sell and recognize about $10,000, $15,000 in losses on that lot, while the overall other positions were a gain of about $17,000. So net overall, it was a $2,000 gain, but they were able to recognize this year a $15,000 loss to offset other gains. The gain harvesting, just as I was saying, if for some reason, as even described in some of the earlier segments, if you are at a lower tax bracket, normally you're at the 20% capital gains rate, and this year you're going to be at 15, could be a good year to save an additional 5% by taking the gain while you're at that lower rate.
Thank you very much. So strategy number 5 is to make sure that you execute smart educational savings planning strategies. Steve, what should we be aware of for this strategy?
Sure. So let's discuss the use of 529 plans, especially by grandparents. We're going to look at not for the parents or the kids directly, but the grandparents actually owning the plans. The FAFSA and the CSS, which are the forms that you fill out for student aid, both for public and private schools, require a 2-year look back at income and looks at the assets. Well, assets in the grandparents' names are not considered, but when the grandparents pay for school, it could go into the income of the child or the parent, depending on how it is allocated out. And the advantage is that this 2-year look back that the form requires allows you to pay from the second semester on sophomore year all the way through the end for junior and all senior year. So you can pay for 5 semesters and it will never actually go into the FAFSA form and be recognized, at least how the law is written now.
Thank you very much. The 6th strategy for today's video is practicing tax-savvy estate planning on an annual basis. Steve?
So we're talking about trying to reduce someone's overall estate and what are ways to transfer money out of those estates. Everyone has probably heard of the annual gift giving, the exclusion right now, the limit is $17,000. That is indexed, I believe it used to be $500, it might be $1,000 depending on inflation. So it would go up to either $17,500 or $18,000 next as inflation continues to creep up, and that limit will go up over time. So you're allowed to give that amount to each individual person. If you're a couple and you have 2 children, right now you can give each child $34,000 for a total of $68,000 out of your estate, and that's not considered a gift that's going to go against your exclusion for your estate tax purposes. Other things that you're capable of doing, you can pay medical and schooling costs directly. So if you have a grandchild going to college, you can pay their bill, but the money cannot go into the student's hands. It has to go directly to the college. You pay them that way. If you have a child or, again, a grandchild that has a medical bill, they're having surgery and they have a couple $1,000 bill that, as a deductible needs to be covered at the hospital, you can pay that bill directly, never allowing the person to actually have the money first, because then it's a gift to them and then they're paying the bill.
Great, and it's great to know not only are you really giving your loved ones some very, very nice finances, but you're also getting any growth of those finances also out of your estate.
Absolutely correct.
Excellent. And Steve, the last strategy that you wanted to talk about today is the number 7, which is taking advantage of opportunistic tax bracket management. What do you mean by that?
So we're looking at year-end management. So when you're looking at what income you have for the year, let's say you're right at the borderline between 2 brackets, or maybe just over a certain bracket. It's talking about looking to try and advance or defer income so you have it into a lower tax bracket. So if you're going from the 24 to the 32% tax bracket, this year, if you earn another $10,000 and you have an ability to defer some income, or you have the ability not to sell something and take it the following year, it's making sure that you recognize as much income. You want to maximize the bracket you're in without going over to the next bracket a lot of times. And that's what you're paying attention to. So it could be the sale of property, the sale of assets. If you are self-employed and you're receiving some form of bonus or something through your company, you can defer that maybe to the other thing, or maybe your company allows you to do some form of deferred comp to a later time. A way of doing that is you defer to a year when you need it. Let's say you know your kids are going to college in 5 years. Defer for 5 years, it'll grow in some form of assets, and you'll take it out then. It will become income at that time, but this way you're currently at a lower tax bracket.
Great. Well, thank you very much. Well, these are the 7 strategies that we wanted to highlight for you today that you really should just take serious consideration on before year end, because it's a use it or lose it. And we want to make sure you get the biggest bang for your buck. So, Steve, thank you very much for being on Wealth Management for Physicians today. You've given the physician audience a lot of great things to think about.
Thank you very much for having me.
Great. If you'd like to discuss the information explained in today's video, receive a complimentary review of your investment portfolio, or a retirement readiness analysis, or discuss any other personal financial planning area with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732, or by emailing Jesse at his email address, which is also in the description of today's video. If you like today's video, please click the subscribe button below and hit the bell icon to receive notifications each time we release a new one. If you think that a fellow physician would find this video interesting or useful, please share it with him or her to help them strengthen their finances. Lastly, as always, if you have topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we'd really love to hear from you. So please give us your comments in the comments section below. Well, that's all for today, physicians. Thank you very much for attending today's video, and I look forward to being with you in our next one. Until then, please remember to keep strengthening your finances, or let us help you if you'd like.